Very good evening to all of you. Welcome to today's YouTube live session with me, Srojit Kakkar. Today is Sunday, 21st of January 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So today's session is our weekly session for the practical application of demand supply methodology. And what we'll be doing in this session is I'll be taking some practical example wherein we will be applying everything that we learned in the basic lessons, advanced lessons to understand how to plan trades in a very mechanical and rule based way using demand supply methodology. Now, today's example will be an example of a script which is making all-time highs. So when a symbol is making all-time highs while doing the curve analysis, you will be able to find demand areas, but there'll be no supply zone. So how do we do the analysis in such a scenario? So that is what we'll be looking at it as an example for today's session. And I'll again add, if you are liking these sessions, make sure you hit the thumbs up button, like the video. If you have any of your friends or family members who are struggling with trading or are interested in learning trading, you can share the link to the courses with them. Plus, if you're on some trading group, you can also share there. If you have any questions, you have any comments, you can definitely put it in the comment section. So let's get started. But yes, before we get started for the analysis for today, like whenever we do the analysis, I don't disclose the name of the symbol we are analyzing, but like I said, once those trades they get triggered, I will be sharing the name of the symbol while we review that particular trade. So we have one trade which got triggered, so we will be starting with its review, and after we are done with the review, then we'll continue with the trading example or the practical example we have for today's session. All right, so just give me a second, let me bring up the charts. So this was the trading idea that I shared with you, which was the second trading idea for the year 2023. The session was done on 30th of December. So if you want to watch the session, you can definitely go back and watch. And what I'll do is I'll do a candle replay so that we can understand how the chart was while we did the analysis. So this is first. So when we did the analysis, the chart was something like this. And when we did the analysis for this one, we qualified it as a type 2 type 3 trade. That when the prices are back, we can do it as type 2 type 3 trade. And at this point of time, if you will see, while we did the analysis, we were planning our trade low on the curve. So let's just give a few seconds. So you can see we were planning our trade low of the curve because, like I said, the location is taken from the proximal line, not from the distal line. So from the proximal line, we were low on the curve. But what happened with this trade was, eventually, it did not came back to this zone the same, I'll say, week. It started moving up. So just give me a second. You can see here it started moving up. And then after a while, it started coming back to our zone. So let's bring in more candles on the chart. So now if you look at our trade plan, right, our trade plan, when we talk about the trade plan steps, we have a step which talks about that before entering the trade, we have to re-verify that does the trade still qualify based on our trade plan or not. Can you see it says verify when the price is about to enter the zone, and we'll have to re-verify. Now, why do we need to do this? Because the markets are not static, markets are dynamic, conditions are changing almost every other second. You can see the time we did the analysis and by the time prices they started coming back, a lot of price action has happened. And because of this new price action that developed, things can change where we might have to make some modifications to our trade setup as well. So the modification which happened here is, can you see, while we did the analysis, we were not at the best location. But when the prices already moved up, you can see this we completed. Now we have a formation of a newly formed demand, which is this drop-based rally. And the indicator is also identifying it for us. And the previous session, I showed you an example. I guess it was the previous session or maybe a session before, where I talked about that. Again, when I see such scenarios, I like to be on the conservative side and I want my stop loss to be at the safest location. And I know that if I'm doing something like this, a worst case scenario can be maybe the prices, they stop me out, they go a little deeper into this weekly demand zone. And after going a little deeper, they can start reacting and I'll be in a stopped out trade and it can start going in my favor. And when I see such scenarios, I always prefer to have my stop loss at the best location, which is where I would like that my stop loss should be here. Now again, the reason I'm giving it a different color so that you can differentiate between the two zones, which is from the higher time frame as well as the lower time frame. So now we are definitely at the best location, but this is one thing which I would like to take care of. And again, if you watch the previous session or the session before, we had a similar scenario where we did exactly the same thing, but then we further fine-tuned our zone based on the lower time frame. So if I do the exactly same thing here, thereafter understanding, okay, this is where my higher time frame demand is, and I would like to have my stop loss at the safest location. Do we have any other zone on the lower time frame in this area? So let's wait for the indicator to load. Let's give it a few seconds. You can see we do have this drop based rally demand area, which is right here. So in such a scenario, I would have preferred to shift my zone to this lowest one, because that puts my stop loss at the safest location. Now, is it mandatory to make that modification? I also said in the previous session where we did something similar that it is not mandatory. It completely depends from person to person. Every trader has a different personality style. Personally, I prefer to do this. If I see that I can put my stop loss in a better location, why not? In such a scenario, worst case can be I might not get a fill and the prices might start going in my favor, which I'm perfectly fine with. But getting stopped out and then going in my favor is something which would pinch me a little more. So that is why missing a trade is still fine, but having my trade as the best setup is what I'm always keen on. So this is the modification which we should have made by the time prices they started coming back to our zone. And when the prices they started coming back to our zone, we would also have to check how is the reward to risk ratio. And for your reward to risk ratio, we don't require quality areas. Anything that is a structure of demand or a structure of supply can be used for your target. So let's bring in more price action to see what happened. All right, so let's bring in more candles. All right, so moving ahead candle by candle. Perfect. So can you see, this is what I was telling you, that if I would have not made that modification, I would have been in a stopped out trade, and then the prices they went a little deeper into that weekly zone, and now they have started reacting from there. So this is why I always prefer that my stop losses should always be at the best location, and this is one of the modification we also talked about when we were doing the session, which was, I guess, the last one or maybe just one before that. So I can't recall what symbol it was. Anyhow, I'm not sharing the name of the symbol at the time of analysis, but I'm pretty sure it was the last session or the session before. So here you can see when the prices they started coming back to our zone, our opposing fresh area of supply. Can you see these supplies are already tested? This is my fresh supply, which is showing me a reward to risk ratio that is approximately, let's see, how's the reward to risk ratio, because this is the zone which I would not like to use now because of the price action that has developed. And based on what I have as an available zone now, if I'm looking at my reward to risk ratio, the reward to risk ratio would have been, you can see 1:1, 2:1, 3:1, 4:1, then somewhere around here would be 5:1, this would be close to 6:1. So we have a beautiful reward to risk ratio that is almost like 6:1. So this would have been a valid trade for us, even based on the reward to risk ratio. And on the very first candle, you can see we have already passed our 1:1 mark, where you would have got the opportunity to revise your stop loss from the distal line to your entry price. And after that, if I bring in more data, you can see as of now, we have had few formation of newly formed demand areas, but these newly formed demand areas have not yet violated any supply zone. So let's wait for the indicator to load. So you can see we have some newly formed demands, but the supply has not yet been violated. So since the supply has not yet been violated, we can't start trailing onto it. So what we'll have to do is we'll have to wait for the violation of the supply zone. Once this supply zone gets violated, whatever will be the latest form demand area. As of now, you can see this is the latest form demand drop based rally. Then we can revise our stop loss to the distal line of this one, wherein the worst case scenario will be if the prices they come down, we still get a little over 1:1. But if the prices they continue towards our target, we'll keep trailing onto it. So that is what we will be doing. So as of now, we will keep it as an open trade with the trade management in place, where we should have converted it into a break-even trade at 1:1. Eventually, if it goes up, We'll also have the opportunity to trail onto it unless and until we reach to this target, which is approximately 6:1. So again, I'll keep it as an open trade. We'll track it for the next few coming days, and we'll see how this progresses. Again, I'll add the modification that we talked about. If you want to understand it better, we did do the analysis, which was probably the last session or the session before. You can watch that session to understand what this modification was and how it can be a little helpful. I did try to touch upon it a little bit, but yes, in that particular session, we went a little more in depth into it. All right, so that is the modification. And now let me also change this to, so this would be our demand zone now. So let's change this to, so it is a little bit challenging to select. I should be able to do it now. Perfect. Let's change this to demand, and that's the modification which would have happened. Perfect. So that takes care of the trading idea, not the trading idea, the practical example that I shared with you, and you can see how things they can eventually change, and that is why in the flow chart we have this as a rule for us that before entering the trade we'll have to re-verify some of these conditions, because markets are not static, markets are dynamic, and based on that the dynamic nature of the market, a lot of things can change, wherein we'll also have to adapt to those changes. And this is why very, very important to be mechanical and rule based, and plan trades purely based on our rules and not based on our emotions. All right, so let me bring up the example which we will be analyzing today. So I'm just setting up the charts. Just bear with me for a few seconds. And once my charts are set up, then we'll start with the analysis part. All right, so I'm almost done. So let's get started. Perfect. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. And whenever you're learning something new, I do understand initially it is a little bit challenging to create a trade plan, because it can only be done with time and experience. The very first day, you don't have a understanding of the strategy. So creating a trade plan in itself becomes a challenge, and that is where these documents come in handy for you. So I have shared two documents. The first one is your trade plan steps, which is basically a flow chart. You can also call it as the walkthrough. And this guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. This rule book is a conservative approach. With time, with experience, you can definitely make modifications to it to make it better suit with your personality style. But at least you do have a starting point to start planning your trades in a very mechanical and rule-based way. So what is our step number one whenever we start planning our trade? Our step number one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason for that is whenever we are doing our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many options available out of these number of time frames. Which time frame should I be using for my analysis? And to overcome this challenge, we don't start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. Now, what I've done is I have divided these trades into 4 different purposes, and we call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days. But since our markets are not 24 hours market, and whenever the market opens, I'm pretty sure all of you would have experienced some stocks they gap up, some stocks they gap down. And because of this gap up, gap down, what can happen is we can have profit which is much bigger than what we were anticipating. That's the positive side. Negative side is if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So that is why my recommendation to all of you is initially hourly, daily, strictly intraday. Weekly, monthly is anyhow we're not expecting the exit the same day. So you have no choice but to keep these positions as overnight positions. But that does not mean you cannot have a gap against you for weekly monthlies. It can happen. But since we are leaning against some bigger time frames, the probability definitely reduces. But with time, with experience, if you want to include even daily incomes into overnight trades, that can definitely be done. So let's assume I want to plan weekly income trades. So as soon as I choose my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis, lower time frame is the time frame where we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So now we know what are the 4 different time frames and what is the purpose of each and every time frame. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And the answer comes from this table. Like in this example, I want to plan weekly income trades. So as a weekly income trader, my time frames are weekly, daily, 60 and 15. Weekly is the higher time frame, which is used for curve analysis. Intermediate is daily, used for trend analysis. Lower time frame is 60. That is where we get our ACTS from. ACTS stands for stop loss, entry, target, and size. And in case I need to make some fine tuning, or I need the refining time frame, let's say for some additional rules, then my refining time frame in this case will be the 15 minutes chart. Now again, I'll add this particular table is for NSE market, which is open for a short duration, which is 6 hours and 15 minutes. But when you're trading markets which are open for longer durations, like your commodities, forex, cryptos, or even the international markets, which might be open for longer duration of times, then you can look into this table for your time frames. So yes, I opted weekly income as my trade purpose. I got to know my time frames, which will be weekly, daily, 60 and 15. So my challenge number 1 is taken care. I know what time frames I'll be using. I know what is going to be the purpose of each and every time frame. Next is challenge number 2, and that challenge number 2 is, yes, I do know my time frames, but on NSE we have approximately 2000 companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need to do now is I need to have a process in place for getting a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 companies, not possible. So the way we do this is by using certain computer programs, which are called as scanners or screeners. And the way these computer programs, they basically work is we input certain conditions into them, and then the computer programs identifies that out of these 2000 companies, which companies are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a small list. Now, very important, no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks. So the job of the scanner is not to tell you what you need to buy or sell. Job of the scanner is, I can't analyze 2000 companies, help me find a small list. Once you have that small list, you'll have to analyze all these symbols one by one. Whatever matches with your trade plan can be your trading opportunity. Whatever does not match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to our website under free tab, you will see I have created a scanner for all different 4 different purposes of trades, and those scanners are based on some moving averages. Second example, on my YouTube channel, if you search for scanner, you will be able to find few videos, different logics, different scanners. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can also help in shortlisting some symbols. So let's look at few examples before we move ahead. So like I said, once you go to our website, under the free tab, you have stock screener. Because I opted I want to plan WIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 3 symbols for me. The short scan is shortlisting none. Now, very important, like I said, just because I'm getting a list of 3 stocks from the long scan does not mean I can blindly buy them. Again, the job of the scanner is not to tell you what you need to buy or sell. The job is I can't analyze 2,000 companies. It just gave me a list of 3 companies. I'll analyze these 3. If any one of these matches with my trade plan, it can be a trading opportunity. If it doesn't match with my trade plan, I don't have any trading opportunity. Now, many times what can happen is your list might be a very small list, like you can see today, or maybe nothing is getting shortlisted. So if you want your list to be a little bigger so that you can look at more number of symbols to identify your opportunities, then what you can do is you can see that in this scanner, I have given 5 different conditions. You will disable the third one and you will run the scan again. And I'll do exactly the same thing here. I'll disable the third one and I'll run the scan again. So initially you saw that we got a list of only about 3 symbols, but now I have a list which is 88 plus 15, which is about 103, right? So I have about 103 symbols which I can look into. Now, it's not a very big list. It's still a very small list. It's not that you have to analyze 500, 600. And I'll say if you are analyzing about 100, it can easily be done within probably 30 minutes or to the max, maybe 45 minutes. But if you feel that this is still a very big list and you want to further filter it out, you can use different filters. Like example, you can say, I want from the futures only, or maybe I just want from my Nifty 50. So this time let's select Nifty 50. I'll run the scan again. I'll do exactly the same thing here. I only want from the Nifty 50 stocks. I'll run the scan again. So now you can see if I go back, instead of 3, now we have 5. And if I go here, then we have 3. So now I have a list of about 8 symbols to look into. So this is how you can make your list a little bigger. You can make your list a little smaller. Plus, these are not the only scanners that are available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners listed. Some are based on fundamental analysis, top left, candlestick patterns. Then you have range breakouts, bullish scan, bearish scan. Then you have your intraday bearish, intraday bullish, crossovers, a number of scanners, a number of screeners, and this is just one particular website. Similarly, you'll have a number of websites, a number of scanner screeners. Like I already said, the scanner screeners, they never tell you what you need to buy or sell. So that is why it doesn't matter which one you're using. At the end of the day, you'll have to do your analysis. You decide what is the best fit for you. But yes, you will have to use one or the other way to get a smaller list. And in this case, you saw that we got a list of about 103 symbols. Now, once you start analyzing them, few challenges which you will realize. Challenge 1, most of the symbols on this list might not have a quality demand area or a supply area on the lower time frame. And the reason for that is because these scanners are not based on demand supply zones. They are based on conventional technical analysis or fundamental analysis. So that is why just because something is getting shortlisted does not guarantee that you'll have a quality area on the lower time frame, which means you might be wasting a lot of time analyzing such symbols where nothing is available. And some of the symbols which might have some quality areas, those zones might be far away from the current market price, due to which you'll have a longer waiting period, and because of that waiting period, conditions can change. Like you saw in the example that I showed you, ABFRL, conditions, they changed. Yes, we had to modify our setup based on the change of those conditions, but at times, because of those change of conditions, by the time prices are back, that zone might not even qualify for you, right? So those things can change. And to overcome these challenges, what I've also done is I have created 2 custom built tools. One is called as the alert service, the other one is the screener. Very important, these are not call giving or tip giving services. These are also scanner screeners. Only difference is that these scanner screeners are purely based on demand supply zones. So challenge number 1 is taken care because they are based on demand supply zones. If something is getting shortlisted, it is only because you have a zone available. If there is no zone available, they'll not be getting shortlisted for you. Alerts, they are generated as soon as you have a formation of a zone on the lower time frame. And because at the time of formation of the zone, you get the alert, the current candle will always be close to the zone, which takes care of the second challenge as well. Plus, we also have some demo channels available for the alerts. So if you want to understand alerts better, you can go to the link which is available in the description. You can go through the walkthrough video. You can join the alerts channel. You can experience it. The other tool is called as the screener, which can be applied to the higher time frame as well as the lower time frame. And in this, you can define how close you should be to a demand area or a supply area before it gets shortlisted for you. And that is how it takes care of both these challenges as well. Again, I'll add, these tools are not mandatory tools. These are optional tools. You will have to use one or the other way to get a smaller list for you. And this process can be as simple as, I don't want to use any of these scanner screeners. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I want to analyze. So again, choice is yours how you want to get that small list, but you will have to use one or the other way to do that, because if you don't get a smaller list, analyzing 2000 companies is not an easy task. So let's assume whatever process you applied, you got a small list. Next step will be to analyze all these symbols one by one. Whatever matches with your trade plan is your opportunity. Whatever does not match with your trade plan, we simply skip it. And let's assume that in that list, the very first one we got was ABC. So what are we supposed to do now? We need to go to the lower time frame. So the question here is, what is my lower time frame? We got the answer from our step number 1, that as a weekly income trader, the time frames were weekly, daily, 60 and 15, out of which 60 minutes was my lower time frame. And on the lower time frame, I need to identify zone. By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go to the chart. And for now, I'll disable all the indicators. Now, whenever we talk about demand-supply methodology, I always say demand-supply is a price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only 2 things. Price can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can call it as the basing. Now, initially, when our eyes are not trained to identify these structures, what we do is we start with a concept which is called as boring exciting candles, because you will see most of the zones can be identified based on boring exciting technique. But as you start having more and more experience, what you need to do is from boring exciting, you'll start leaning towards price action. So this is just a starting point to start training your eyes. Now, if I talk about price action, and if I'm not applying any of these indicators to the chart, even visually, you can see here we have a really nice strong move to the upside. Before that, we had this brief period of pause. And before that, you can see prices were moving up. So if I talk about what is price action showing me, price action is showing me we moved up, we paused for a while, we started moving up, which is a rally base rally structure. Now, initially, like I said, if you want to train your eyes, we have some free indicators available to you. We have the boring candle indicator, which marks all the boring candles as blue candles on the chart. Let me zoom in a little bit. You can see. Similarly, we have the explosive move indicator, which is also a free indicator. So both these indicators are free indicators. You can use them for free forever. So you can see if I start from the current market price, I start looking down. I have this as an explosive candle. Next to it, we have this basing candle. That is why it is getting converted into blue color. Next to it, we have an exciting candle. So the exciting candle to the left of the basing is your leg in. Basing is always called as the basing. Exciting candle to the right of the basing is your leg out, which also happens to be an explosive candle in this case. So you can see, even if you were using your boring exciting technique, we were still able to identify the rally-based rally structure in a very mechanical and rule-based way. And third way is if I disable all these indicators and I enable the demand and supply zone indicator, you can see now this is more like GPS. I don't even have to identify the zones and plot the zones. It does automatically for us. And you can see this is also identifying exactly the same zone for us. So yes, our step number 3 was to identify a zone on the chart, irrespective whether you were using price action, boring exciting technique, or the demand and supply zone indicator. You can see in all the 3 cases, we have this rally-based rally available to us. So what we'll do next is we'll draw the zone. We'll mark our entry stop losses 1:1, 2:1, 3:1. And now our step number 3 is complete, which is identify zone. Do we have a zone available? Answer is yes, we do have a zone available. Now, once we have identified the zone, does not mean we can blindly trade it. And that's the biggest mistake demand supply traders they do initially. They see any demand area on the chart, blindly start buying. They see any supply area in the chart, they blindly start selling, which is incorrect. Once a zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So the first thing we'll check is that is this zone a case of level on top of level? And the reason we start with level on top of level is because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And how do we verify this? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone ITF gets divided into multiple zones on the LTF, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, in the demand and supply zone indicator, you have the option where you can define what is your higher time frame, what is your intermediate, what is your refining, so that when I change my time frames to these time frames, provided you have this option checked marked, then the applicable settings gets applied automatically. I don't have to do it manually. So here you can see once I go to the daily time frame, it will automatically change that it's not identifying quality areas anymore. It's identifying all zones for us. And here you can see that if I'm looking at an intermediate time frame zone, my intermediate demand is this rally based rally. So my lower time frame zone is not coinciding with the intermediate time frame zone. So it's not a coinciding level. And if it is not a coinciding level, it cannot be a case of level on top of level. So level on top of level is not applicable. This zone is not because of a gap. Therefore, gap rules will also not apply. Pivot nor authentic not applicable because we only apply pivot nor authenticity to a drop based rally or a rally based drop. Currently, we have a rally based rally structure, and unstable equilibrium is also not applicable because the leg out is not going below the basing. So if I go back just to show you, here you can see the leg out on the lower time frame is not going below the basing. You can see the low of the basing is right here and the low of the leg out is right here. So it's not a case of unstable equilibrium. So after looking at all these applicable conditions, none of these conditions were getting applied. And if they are not getting applied, they cannot disqualify the zone, right? To disqualify the zone, first they need to be applicable. So after applying the applicable rules, none of the rules were applicable. Is the zone qualified for us? The answer is yes, because if the rules are not getting applied, they cannot disqualify the zone. So after looking into this, the next step will be we'll have to apply the boosters now to understand its quality and the probability factor. So let's bring up the booster sheet and let's start applying the boosters to this one. So the first one is freshness. The zone is definitely fresh. You can see after leaving the zone, price has never been back to the zone, gets a score of 3. Strength, we have an explosive move, which is a score of 2. Time at the zone, we only have 1 candle, gets a score of 2 again. And reward to risk ratio, will take it as an assumption because the reward to risk ratio can change based on the arrival. But since we know that we'll only be taking the trade provided we have RR, that is why we can take it as an assumption. Next thing is your location, which is the reason behind why I picked this as our example for today. So you can see if I go to the higher time frame, I will be able to identify a number of demand areas. But no matter how far back or how much history I load, I don't have any supply because the stock is making all-time highs. So when a symbol is making all-time highs and we don't have any supply zones to draw the curve, then how do we do our curve analysis? So for this, we already have the rule in the rule book. So if I go to the rule book and search for all-time highs, the rule is that for a symbol which is making all-time highs, first and foremost, we do not plan a short trade because it is a strong symbol. So we don't want to go against that strength. If you want to plan some short trades, you can start doing that once you start seeing a supply zone on the weekly time frame. Now, why I have chosen a weekly time frame, because see, when a symbol is moving up, it's not that it will keep moving higher and higher every day, right? It will give you some corrections, again start moving up, again give some corrections, again start moving up. Now, because of these corrections, we might have formation of supplies on some smaller time frames like daily or maybe smaller than daily. Now, I don't want to use those smaller time frame zones as an indication that we have sell-off coming up, and that is why I start planning my short trade. Now, if I use a monthly time frame, yes, it will add even more probability, but going to a monthly time frame and waiting for a supply zone, I might be too much delayed to participate with this move which has already started to the downside. So that is why, because I don't want to be too quick, I don't want to be too late, that is why I have chosen weekly. But again, based on your personality style, if you want to make some modifications to this, that can be done, but this is what I follow. Next, if a symbol is making all-time highs, no matter what trend analysis the indicator is telling you, irrespective whether it is telling you uptrend, downtrend, or sideways, in any of these cases, we will ignore it, but we'll only be considering it as an uptrend because it is a strong stock. We'll always assume it to be in an uptrend. And for a script that is making all-time highs, since we don't know where we are on the location, we should be giving it a score of 0. And what gets a score of 0? Equilibrium location gets a score of 0. Now, some of you might say that, why are we calling it as an equilibrium location when we can already see that we are in a weekly demand area? And this is a beautiful example. Now, even though you're in a weekly demand area, we are not calling it as very low of the curve. We are still calling it as equilibrium. Why? Because we don't know where supply will form. What can happen eventually is prices can come down. We can have some basing happening here. And then eventually we might have a formation of a supply zone. So the area which we were considering it as very low of the curve eventually might be very high of the curve. So since we don't know where supply will form, that is the reason, even if we see that we are inside of a weekly demand area, we'll still call it as equilibrium location, because unless and until we see supply on the chart, we can't do the curve analysis. So that is why all locations will be considered as equilibrium, which gets a score of 0. And since the trend will be considered as an uptrend, we'll give it a score of 0.5. Next is move from the zone. We need minimum 3:1, and you can see we already have a move which is more than 3:1, gets a score of 2 again. It is not a case of level on top of level, not even coinciding. Trap, yes, we can definitely give it a score of 1, because you can see if I take a horizontal line wherever the proximal is, and let's start pushing it up, you can see this area has been acting like resistance, somewhat resistance, but then it has been acting like support, support, support beautifully. Let's see if we have more data from the past. No, because this is where it would have again started making all-time highs. So we'll only see this particular bounce. So yes, because of this area of support and resistance, people who believe this should act like support, people will buy with their stop losses, which will be placed below this, and those stop losses will be sell orders. And if we have a breakout, people who believe in breakout will also start selling. So by the time we enter into the zone, we'll have quite a lot of people selling because of stop losses, because of breakout trading, and these people are making the novice mistake, selling after a decline in price in an area where the chart has proven to us that back in history, demand exceeded supply. So yes, that possibility is definitely there. Therefore, we'll give it a score of 1 for trap. So you can see our scoring for the zone is 10 out of 10 for quality, definitely with the assumption of reward to risk ratio. And if you talk about the probability factor, it's not a very high probability setup. We still have a score of 3.5, which makes it as a high quality, low probability trade setup. And such setups should only be done as type 2, type 3 trades. So this got qualified for us as a type 2, type 3 trade. Next, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, where we will be doing our position size calculation. Now, whenever the prices are back, we'll have to re-verify. You can see the example of ABFRL, where at the time of analysis, we were not at the best location, but by the time prices came back, our location became as the best location. So this is where things can change based on the price action that is developing. And this is why it is a very essential step for us. Before entering the trade, we'll always have to re-verify. After re-verifying, if it is qualified, we will place our order based on the entry type. In this case, it's a type 2 or a type 3 trade. And once the order has been executed, the last step is your trade management. ABFRL is a good example of it, where you can see 1:1. We have already talked about it, making it as a break-even trade. And once it starts moving ahead, which it is already doing, but as of now, an opposing zone has not yet been violated. At the violation of the opposing zone, we'll start using our trailing stop loss unless and until it goes to our target, which in the case of the symbol that we just reviewed was approximately 6:1. So that is how we plan trades, very mechanically, very rule based. And before we get started with the queries I have in the chat box, again I'll add, if you're liking these sessions, hit the thumbs up button. If you're not subscribed to my channel, subscribe to my channel so that you can attend these sessions regularly. Even though the timings are fixed, but at times if I'm not available, I might modify it so you'll get a notification. And definitely, if you're liking these sessions and if you feel that they are helping you, and you know some people or maybe your friends, your family members who are into trading, you can share the course with them. It's an absolutely free course. They can also take advantage of it. And yes, if you're on some trading groups, you can also share about this course on those trading groups. So let's see what do we have in the chat box. So the first one is, in case of drop-based drop and rally-based drop, that is short trade. Our purpose, DIT, WIT, and MIT. Trade will not be feasible in equity as the price will come to the opposing zone on the same day. Kindly guide. What do you do? Okay, so what you're basically saying is that when we are planning a short trade, at times the price might not come into our zone the same day. So what do we do in such case? See, the fact is, this is definitely a limitation, but not the limitation of the methodology. It's the limitation of the market. So what you need to do here is, if you are expecting that intraday I might not get my target, just give me a second, then the best thing would be to avoid it. The things you can take into consideration while planning short trades is, one, at what time you are getting into the trade. So let's say if you're getting into the trade almost at the starting of the session, let's say first 2 hours acceptable. But if you're getting your entry pretty late, definitely doesn't make sense to get into, especially your WITs and MITs. And again, if your zones are pretty wide, then also doesn't make sense, because if the zones are wide, you need a bigger move for a 2:1, which might not happen intraday. But the alternative here is the same trade can be planned on the futures. But futures, they have their own challenges. It might not match with your risk appetite because the lot sizes are fixed. So yes, these are some challenges. Again, I'll say the challenges are not of the methodology. It is of the markets we are trading. So that is where you'll have to have some rules in place. Like I said, those rules in place can be how narrow the zone is, at what time you're getting your entries, and based on that, yes, you can adjust. And if conditions they allow you to take those short trades in anticipating that yes, you might get your target the same day itself, then you can get into those kind of trades. All right. Regarding ABFRL trade in WIT, we use quality demand zones for supply zones for 1 hour, but I see you have used all demand supply zones for analysis for a violation of demand supply zones. Please clarify. So absolutely, when we are doing our trend analysis, for trend analysis and for curve analysis, we use all demand supply structures, because that is where we are not planning our trades, right? We are trying to understand what is the curve, and for the curve analysis, we are using bigger time frames versus the time frame we are taking our trades. And bigger time frames, they always have higher weightage. So that is why for curve analysis, you can always use all demand supply structures. For trend analysis, you can always use all demand supply structures. Now, if you want to be a little bit more conservative, you can go for quality areas, but that will make you miss a lot of trades, right? So everything has its pros and cons. But on the lower time frame, when we are planning our trades, that is the time we're always taking quality areas. All right, so what is the time frame here? So Abhijit, I just saw your message. So I don't know at what time you posted it, but yes, whenever you want to see which time frame I'm using, you can always refer on the top bar here. You can see the one which is a little highlighted. So in this case, you can see 1H is highlighted. That would be on the hourly. If some other is highlighted, then that is the particular time frame I'll be using. But whenever I'm changing time frames, I always talk about what time frame I am on. So that should help. But yes, just in case you missed on it, later you can watch the recording, and from the top you can see which time frame I was looking into at that particular period, at that particular time. All right, so will you suggest once the supply zone has been violated to trail stop loss to the next profit level until the original target is achieved, or you get stopped out? So I'm not able to get that. Let me try to understand it again. Will you suggest once the supply zone has been violated to trail the stop loss to the next level? Absolutely. And the reason for that is because when we are trailing, I would also like to trail, because see, again, for the trailing, we are not using quality areas. For trailing, again, we are using all demand supply structures. So if I'm using all demand supply structures, at least I would like to use structures which have shown me some strength. So a violation of an opposing zone is an example of the demand zone showing me some strength. So that is where I would definitely like to trail at the violation. But again, there can be variations to it. Those variations can be, let's say that the price is still lying on the curve at a good location, right? So that is where I can look into violation of opposing zones. But once the price starts getting high of the curve or very high of the curve, and we know now we are closer to the higher time frame supply, I might want to lock in majority of the profits which are there on the table. That is where, if you don't want to look for opposing zone violations, acceptable, right? So again, based on your personality style, modifications can be done. But ideally, I always prefer to see a violation of an opposing zone if I want to add a little bit strength to it. All right, let's see what we have. Uh, so I am trading futures and options only. Kindly suggest I need to analyze cash or futures chart. What are you doing if you trading? Okay, so in such a case, I would recommend you to start your analysis with the cash, and the reason for that is that when you go to the futures chart, at times you might not have a lot of history available to you, which creates a challenge in doing the analysis. So as far as the analysis part is concerned, you can do the analysis on the cash chart, and what you will see, your cash and futures, they go hand in hand. So if you have a zone on the cash chart, then I'll say probably over 98% of the times you'll also be able to find a similar zone on the futures as well. So after doing your analysis on the cash chart, just replicate the same zone on the futures and take your numbers from the futures. And why am I telling you to take your numbers from the futures? Because then it is easier for you to place your orders based on, okay, this is where I want my entry, this is where I want my stop loss. But if you want to do it based on the cash, that as soon as it comes here, I'll buy in futures. As soon as it comes here, I'll exit my futures position. As soon as it goes to my target, I'll exit my futures position. Then the challenge will be you'll have to be in front of the computer all the time just to watch prices coming into your areas and the times when you want to buy or sell. So the easiest way would be do the analysis on the cash. If the trade is qualified for you, then just replicate the same zone on the futures and take your numbers from the futures, which will make your life a little bit easier. Yes, there will be times where you will see that in the cash you might not be stopped out, but in the futures you might be stopped out. You will also have opposite cases where in futures you will not be stopped out, but in cash it might be stopped out. So you will have to accept it, right? You will have some winners, you will have some losers. But at the end of the day, the thing we are trying to do is to make our life a little easier. And the easiest way to do that is do the analysis in cash. If it is qualified for you, just take your numbers from the futures. But yes, if you feel that you have a lot of data available in the futures where you're able to do the complete analysis purely based on the future chart, then why not, right? That you can even do it. You can even do the complete analysis on the futures chart. All right. Let's see. Wouldn't be more practical to use scanners with a pre-specified price range of limit the numbers of candidates to analyze potential opportunities and optimize it? So that is what I'm doing, right? That is what I'm doing. The examples which I'm sharing with you, I always use these scanners, and based on those scanners, whatever gets shortlisted for me, out of that list, I share these trading ideas with you. In fact, all these trading ideas I'm sharing with you, most of them I'm already holding some positions. And what I'm doing is I mostly do MITs, and now I'm just converting the same trade into a DIT or a WIT and sharing the same thing with you. So that is what I'm doing. But yes, majority of the times, not majority of the times, I should have said 100% of the times, I'm always shortlisting based on these scanners, and out of that, I'm selecting my trading ideas. All right, I will not trade any other way than strictly using your methodology, using demand supply. It is perfect because it forces you to follow specific steps to validate your trades. And absolutely, and that is very, very important. And that is what I've also explained in the video, which is how to start trading, why you need to be very mechanical and rule based. I know it is easier said than done, but once you start practicing, you will realize that's the right way to go about. All right, do you use notifications to help you re-verify your zones prior to the entry as you showed at the beginning? Absolutely. So you can see here, my alerts are always placed just before the zone. So I don't place my alerts exactly at the zone. I always place it just before the zone so that I have ample time before I place my order just to quickly review and check whether some modifications have to be done, whether it is still qualified or it is not qualified. So I always prefer my alerts to be a little before the zone, not very close, not very far away, but I generally try to keep it at a distance where I know that I'll have ample time to re-verify before I try to get into the trade. All right. So I have been through your booster course, but a link for LOTL and pivot will help. See, again, we just started with these practical sessions. Now talking about level on top of level, I have already done a session on level on top of level. So the thing is, you people will have to be, when it comes to these sessions, you need to be attending these sessions almost every other week, because you never know which session, what topic I'll be taking. Like today's example was a case of all-time highs. So if you are attending these sessions, all these things will be taken care of. And yes, that's the only way eventually to cover all these different scenarios which we have covered in our lessons. So you just be consistent with attending these sessions, and all these things will be taken care eventually. All right, so let's see what do we have next. We want supply and demand indicator for crypto. See, the indicator can be applied to any market, be that cryptos, be that forex, be that commodities, be that the Indian markets, be that the international markets. So it's not that there is a different indicator for these markets. But what you need to remember is that the indicator does not give you buy sell signals just because it is getting, marking a demand area for me. I can't trade it blindly. You will always have to do the complete analysis like you're learning in these sessions. And only if these zones they get qualified based on your trade plan, then you can use them as your trading opportunities. All right, you can force your will to the market, and you need to be flexible in your approach and adapt sticking. Absolutely. See, at the end of the day, markets are always right, right? That is how it is. So what you need to do is you need to have a trade plan laid out for you, where if these are the conditions I'm getting into a trade, if this happens, I'm exiting the trade, and this is the kind of loss I want to take in a trade, provided this was the kind of profit the trade was showing me, I would have participated in that trade, right? So that's the only thing we can do. And yes, absolutely, I'll agree with you that nobody can make the markets do what you want them to do. The markets will always do what they have to do. You just need to adapt yourself to those conditions. All right. Is there something fair value gaps? See, again, when we talk about gaps, we only talk about two kind of gaps, which is pro gaps and novice gaps, and we are always a little bit more inclined towards the pro gaps if you want to plan some trades, not towards the novice gaps. All right, right. So perfect. Let's see what do we have next. Your live sessions are very informative. I'm learning a lot of golden nuggets to help me with my trading low. So I'm happy to know that these sessions are helping you. Okay, so Sumit, hi, nice to see you. And again, that is the idea behind these sessions, because see, what happens is when we are learning something theoretically, the examples that you see in theory are basically textbook examples. But when you get into the practical application, markets are not textbook examples, right? And markets conditions are changing, conditions are varying. And that is why the more number of sessions you will see, the better understanding you'll have of how to apply the process, how to apply the methodology. And yep, that is what my idea behind is in in taking these sessions. All right, great. So let's see what do we have next. Why the zones are not working at let's see, at breakouts. Okay, so yes, there is a rule which talks about that if you have zones which are formed at breakouts, they are generally a little lesser probability. Now, just to help you understand, very simple, if you think about breakouts, right? Breakouts is where if you have some zone formation. So let's say, let's take an example. You have something like this, and then the prices they came here, you have a formation of a zone, and then you have a breakout. Now, if you think about it, people who believe in support and resistance, right? They know that this was a resistance area. Now they should act like support. So wherever everyone else is buying, you're also trying to buy at exactly the same area. So that is why the probability reduces. But if I have a zone which is a little below, now this zone can act like a trap versus the zone which was exactly at the same level. So that is why we have that rule that the zones which are located at breakouts are generally a little lesser probability. I would not say that it will apply to almost every other zone. As we move ahead, I will show you maybe some cases where the zones might be at breakout levels, but they are still high probability zones and that can be traded. But there will also be scenarios where they are breakout zones, but we'll not be looking into them because they might not be very high probability setups. So that is how it is. So eventually, yes, we'll have all these different examples. But yes, at least now you have an idea behind why those breakout zones are generally not very high probability, because whatever conventional technical analysis people are doing using zones at breakouts, we are also doing exactly the same thing, which does not give us any edge, right? So that's the challenge there. All right. So again, thank you so much all for joining in. I'll see you next Sunday. Till then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.